Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. Today on the EIA show, we're going to break it up into our normal, the summary, deeper dive into U.S. products, and then going abroad, looking at U.S. exports and what's happening in the global market. So before we get into it, we like doing that little bit of a summary. So we did get a nice crude draw coming from the U.S., but it was a little bit below what some of the whispers were. It was kind of in line for where the expectations were based on some of the outside surveys, below where things came out against API, but there was a fairly large disconnect in it's essentially a number that the EIA uses to help things balance, and it's up to about 10 million, and it typically happens when there's a big shift in exports, imports. There's typically something, because it always catches up, but it takes time. And that's why we talk about it's called the EIA show, but as you can see, we try to talk about moving averages against seasonality, just because over the course of 4 weeks, things kind of smooth out, but it takes a little bit of time to get all this data caught up, because there is a lot that they're trying to compress for everyone. And even though we did get a nice crude draw, we did get a decent build in gasoline that was kind of counter seasonal. Distillate, small draw, but we're starting to see that adjust. And it comes down to just, again, demand not being where it should be, or where I think expectations are. And it's always, the next 4 weeks, it's coming in the next 4 weeks. This isn't crowded, but again, these are things that are starting to catch up as we look abroad, and then we look at some of the amount of product that's available, and we continue to see some of these builds, especially on the light distillate side, as the Delta variant of COVID, has a little bit of a resurgence in Asia, which again is kind of impacting some of these movements, shifting some of this crude into the U.S. And now our focus turns to OPEC, which is going to meet. I think it's now officially tomorrow. It was one of the meetings was supposed to be today on Wednesday, and now it's going to be on Thursday. With both, the expectations are for a 500,000 barrel a day increase for August. And then the next meeting after that is so far set for July 27th. So we're going to see, maybe they're going to adjust for some of the draws that we've seen in some of the different areas. But now we're starting to see some of the adjustments in China with some of the cuts in teapot runs that are expected. But those are things we'll go through in segment 3. So just looking at where crude oil inventory is, excluding the SPR, you can see right now we're tracking the rate of change for the 2019 and 2017. And the reason why we talk about that is because we're supposed to draw oil right now. Like this is the period where refiners are ramping up. They're pulling down some inventory. They're putting some refined product in storage, or seeing some product move out of storage. But right now, when you look at the rate of change, is pretty much spot on with where things were in 17 and 19. So we're not seeing anything too crazy. It's just it started a little bit earlier, which is that positive. But now we're seeing a pretty steady move against the seasonal norms. So now when we look at what's happening with imports, what's happening with exports, and if you remember, I said in the third or fourth week of June, we were going to start to see that flip. Now, if you remember, everything with the EIA is a week back. So now this week is where we expect to see some of these shifts. We're already starting to see them, and that's going to accelerate as we go through the month of July, which we'll talk about in a minute. And now when we look at days of supply, you can see that we've moved down closer to where we were in 2019. We're now through where things were in 2016, 2017, which was that big increase when there was that market share fight in terms of where OPEC was. And we're coming down now. This is something that, as we've been saying, we expect this to really kind of flatten out and see that essentially adjust over the next few weeks as we see that adjustment between import and exports. And it's funny because we keep seeing a lot of these comments about this really tight physical market, and the physical market is so tight and this. But then something that just crossed today, like Trafi sold 100,000 tons of Urals for July 10th, 14th delivery at dated Brent -2, which but that last traded at -70. Then you look at Libya raises their OSP to an 11-month high to $1.35. So it's good to see some of the OSPs going up, but it doesn't mean that we're not going to see some of these fights in between in terms of, okay, well, this is where we're going to start and then it'll cross somewhere lower. And the fact that you have euros moving the way that they are versus Libya, it's going to be difficult to see how some of this product moves about. But then when we look at U.S. commercial oil storage and products, so we're just looking at the basics in terms of what's happening with crude and products, because again, oil becomes products. So when you're thinking about, oh, well, oil had a really big draw, okay, but what happened with the product side? Are we seeing something that is above normal? Are we seeing this accelerated drawdown? And once you kind of layer all this together, you can see that things have flatlined a bit, which is really what we were saying, where the pace of draws was going to really abate. And we were still going to get them, but it's just the pace was going to adjust. And you can see the rate of change has softened a bit versus where we were in 2017 and where we were in 2019. Now, we should see an acceleration for the 4th of July weekend, which is obviously this weekend, but you're going to see some of this gasoline moving into the market, making sure that some of this is pre-filled. Then we'll get a slowdown and then kind of that recoup, and then we'll go through kind of the peak of driving season, which is typically the month of July. So then when we look at gasoline storage, you can see that if we take out 2020, because obviously 2020 was a unique year, we're at all-time highs. So obviously you have that delta between now and 2020, but when you look at it against all of the other 28 years, you can see that we're really at that all-time high, just off the recent high from about the middle of June, but still trending up as we continue to see gasoline be the focus, but really not seeing that other side of demand. And now we're starting to see some of those reversals that we've been talking about when it comes to exports, which we'll again cover in segment 3. So when we look at distillate, distillate is moving along kind of that normal trend. It's much closer to normal. And the reason why is when you look at the refiners, refiners have ramped up, but they've been targeting the top of the stack or more of a gasoline cut, which is again led to the gasoline storage. And they've been trying to mitigate or minimize the amount of middle to heavy disti that's been created. And that's where if we want, given where they're running now, that's going to have to flip. And we're already starting to see that flip again, coming to the export-import swap. But you can see right now that we're tracking pretty close to where we were on the aggregate. There's really nothing impressive. The rate of change is pretty steady, which is a positive. And by positive, I mean fairly bullish for storage, for some of the cracks, just because there's a lot of room for disti at this point, and it's fairly within normal range. And then when we look abroad, it's a little bit different, where distillate, we continue to almost be the dumping ground for the most part of this floating distillate, because there's still a significant amount out there that is trying to find a home, which is why we keep seeing our distillate imports stay very elevated versus what is normal for historics. And then when we look at jet fuel, obviously, if you take out 2020, we're still at a all-time high, but that has gone essentially flatlined. And that's what we've been talking about, where jet fuel is really just going to go flat. And you're going to get some increases, but decreases, and we're just going to go sideways as we go through the rest of the summer. So then when we look at where the curve is right now, you can see that there's been a little bit of pressure in the back months, but realistically, as we go through 2025, you can see that we're above 65 into essentially the middle of 2022. Then when you go to 60, we're essentially at 60 as you go through the end of 2023. So again, there's more than enough room for hedging. There's more than enough room to say that activity should maintain its current pace, and that's where it's something very stable in terms of what we've seen. And we're not seeing this huge increase in the U.S. just because realistically we can't, as we talk about in the frac spread show. But again, there's more than enough support to see some of the current run rates maintain. Now, as we talked about with COVID cases, when we look at some of the net, we've seen this flat line. The U.S. has seen a little bit of an uptick in cases. Europe and the U.K. UK is a little bit easier to see. The U.S. is small, so it's only essentially an extra, I think, 10,000 cases. So we're not seeing anything real pretty large. But then when we look at India flatlining, Asia Pacific is actually starting to go up a bit. And it's really because when we look at Indonesia, Malaysia, that's where we continue to see some of these elevated levels. And then when you look at South Korea, you can see South Korea remains high. And now Japan has stopped going down. And a lot of this is being blamed on the Delta variant. And when you look at those who are vaccinated, you're seeing very few, if any, hospitalizations, deaths. So there isn't, it's effective against keeping this from getting much worse than it already is. But again, this is the kind of stuff that it just prolongs some of these downturns, especially in some of these regions where there aren't that many vaccinated. And again, it comes down to choice. It's like, do I have to eat at that restaurant or will I hold back? Well, do I have to go out to get the food this week? Do I want to go shopping? These are some of those compressions that we continue to see as the Chinese data has gotten worse, which again, we'll talk about in the econ show. So then when we look at just, the breakdown of the U.S. draws, you can see that the crude draw came in at 6.72 million. It was pretty much across the board. PADDIII had a build of about a million barrels. And that was where we saw a big spike of imports. And it always, just because of all of the issues in PADDIII with the containers and ports, that's where we continue to see some of the this sluggishness in terms of timing and on when this is coming on shore. But that started to reverse. When we look at PADDIII was where we saw the biggest draw of 4.9 million. That brings us, below the 5-year average by 6.9 million. But then when we look at Cushing had another nice draw of 1.46 million, bringing us 9.7 below the 5-year average. Closer to the, when we look at it over the last 15 years, it's very close to kind of that 15-year average, which is a positive. But when you look at the spreads, that's where we're starting to see the spreads change and really hold at that level, which is, again, creating that flip from exports back into imports, especially as when we look at refiners looking to increase and they are going to have to run a heavier slate. But then when we factor in the SPR, there was a draw of 8.12 million, which again is going to continue as the SPR continues to get sold. The infrastructure bill that was passed, a lot of that, some of that is going to be financed with more SPR sales. So that's something that's going to maintain its fairly steady course. Production has us at 11.1, where we have us a little bit higher, closer to 11.35 at this level. But again, the EIA production estimates is using a rig model versus a spread model, which is where some of that variation is. But when you look at the final numbers that come out, like we've already seen March, you can see that it's much closer to where we are. Then when we look at total land storage, you can see that things have normalized a bit in the east of Suez. And when you look at that 5-year average, the comps get easier. So when we were talking about a lot of the storage, we were expecting it just to go flat. It was tracking 2020, and then we started to see some reductions of imports. We started to see let's focus on drawing down some of the spare capacity. And that has been a positive for taking some of this out of storage. And then when you look at west of Suez, you can see that there's typically a drawdown this time of year, but it accelerated. So this is positive in terms of that rate of change that we continue to talk about with when you look at west of Suez. It was following the 5-year average. Now it picked up a bit. That's something that we think is just going to abate, and you're going to see it just essentially follow that 5-year average. But it's important to talk about this is what normally happens this time of year. We normally have a drawdown, and it's just what is happening in relation to normal. And that's something that we always want to look at, because in total, stockpiles fell 4.3 million to 630.3 million after falling to 17 million the previous week. So again, you're starting to see some of these adjustments in general. And it's just, again, these are things that are fluid. We always want to look at to see, okay, well, what's onshore storage doing, but also offshore. So here you can see that, and as we said last week, we had cargoes go from storage to transit. So even though we did get a nice drop in storage, we did get a big increase in transit. So that's, again, some of that that flipping as to where is a lot of this product going. West of Suez has come down. That's going to start to reverse a bit. But east of Suez, again, it's fairly stable. We don't see it changing all too much. And we just see it, again, going more sideways with some adjustments when we start looking at West Africa. But we'll talk about that in the third segment. Then when we look at fuel recovery, you can see Europe has cooled off. North America or the Americas, same thing. Rest of Asia as, again, facing some of these adjustments. China's gotten a little bit better. This is a bit delayed. China's recovered a bit more, closer to about 92%. This has, I said, about 87%. So again, you're starting to see some of these adjustments, but we're still not seeing road fuel demand coming back to that normal level, which is putting pressure on that global product side, which is why we continue to talk about crack spreads and where some of these storage levels sit. Then when we look at imports into oil inventory into PADDIII, it's always important to look at rate of change, seasonality, and right now we're tracking essentially almost perfectly where we were in 2019, and we're seeing some of those movements in general. This will continue to get draws from PADDIII. This is where, as we go through this week and then into next week, that's going to abate a bit, and just the rate of change is going to soften. But when you look at 2017, even when you look at 2016, we did get some of these draws. It was just a much shallower slope, and that's where we're going to start to see some of that movement. The draws started, essentially the same time that we saw with 2017, and then they obviously accelerated, which was a positive, and that was because refiners were trying to work through some of the inventory, try to create that gasoline on the expectation that we're going to see this big pickup in driving. And now that we've started to see a little bit of a pickup, but not the same amount, you're going to start to see them shift to a heavier cut, especially if they want to get back to some of the normal run rates that they're used to over the last several years. Then when we look at Cushing, this is what we were talking about, that nice drawdown, bringing us much closer to that 15-year average, which is, it's still lower. It's still about 500,000 barrels lower. But if just based on the sheer size of draws that we've seen, that could be hit, this week. So this is where we expect this to cool off and the rate of change to be a little bit slower. And that's, again, that flip from exports to imports. And it makes sense to actually go backwards, going from the coast to Cushing versus from Cushing to the coast. So that, again, is going to be one to watch. Then when we look at imports dropped 535,000 barrels a day. And it was really driven by PADDII, PADDIII. PADDII had a big increase of 334,000 barrels a day, taking us well over the 5-year average by 201,000. That's going to adjust, and then we're going to see an increase in PADDIII and PADDII imports, which, again, PADDII is very close to the 5-year average, only 38,000 off of it. That's the one that we think is going to, again, kind of stay sideways, but by sideways, I mean it'll be above the 5-year average, but it's just going to work its way out in terms of just staying elevated, just because run rates remain high in PADDII. PADDIII is the one that we expect to see the biggest increase, especially given the shift that we've seen with WTI versus Dubai and Brent, and just where some of these flows are going to move into. Then when we look at crude runs, it was up 0.7%. There was some downtime that was unplanned downtime that came through, as we were saying previously. That has since adjusted. So now we're going to see, the kind of that makeup. PADDIII was the biggest increase of 114,000 barrels, only slightly off the 5-year average, so definitely closing that gap. And in order to see some of those accelerations, that's where we keep talking about having to get that cut heavier in order to function, or I should say to function at the most efficient level, given where some of the where available storage is, which is on the distillate side, and trying to kind of play this game in terms of where some of the opportunities are, while everything remains stable. Now, as we go into July 4th, we should see this hold firm. There's typically an increase in, surprisingly, vacation time. So some of the adjustments come down. You'll see some utilizations dip a bit, but not in any meaningful way. And then once we get to the other side, you'll start to see a little bit of an increase and get closer to about 94% operational rate. Then when we look at implied demand, this is what we were talking about with a small decline in gasoline, down 267,000 barrels a day. That's one where we think it's timing. And when you look at some of the numbers, some of the estimates were at about 8.95. Then you had some of them closer to about 9.2. So again, we're just within this level, kind of moving back and forth with just this peak and valley of demand. And then distillate, as we were saying last week, we're going to see that spike back up, increase 223,000 barrels a day. Jet had that small decline, 149,000 barrels. That's where we could see a little bit of a decline again, just because and we'll go through the TSA data. You typically get the spike into July 4th, which is obviously this weekend, and then a big drop off, and then you start to see that normalize, and we'll show how that happened in 2019, and just based on timing, that's likely to happen again. Then when we look at propane, again, still holding strong, only down 19,000 barrels a day, but still holding well above the 5-year average, which is something that we're going to continue to see happen across the board. Then when we look at some of the backdrops, European imports of clean petroleum product from East Asia fell to zero in June, after hitting the 7-month high in May, but now we're going to start to see that reverse in July. And this is what we were talking about, where they came into the Atlantic Basin and then they had a choice depending on where some of the spreads were. And some of this actually turned into the U.S. instead of going into Europe. And now that's starting to reverse based on right now we have about 3 cargoes heading to for July. There's what we're hearing anecdotally, there will be a 4th. And then that is going to be something that's going to come into the region. And we've seen them taking down and those big builds over the last couple weeks, but still coming just back into normal. On the gas oil side into Europe has kind of adjusted. They needed some time to digest, to take some of this in, and now we'll start to see some of that normalize as we go into July. Now, U.S. imports of gasoline from Europe fell to the lowest in 4 months as that ARB has closed, which is, again, we're starting to work through some of that capacity. Gasoline imports dropped to 161.7 thousand barrels a day, which is the lowest period since ending March 4th. 1 cargo of ultra low sulfur diesel also arrived, which is something that typically doesn't happen this time of year, but we'll go through that in more detail in segment 2. Then when we look at floating storage, it's at zero, and this is something that, again, there's a lot of backlog that we expect to come through. Some of it will go directly to port. Some of it will stay and wait for that unloading, because remember, floating storage, you have to be stationary for 7 days to be deemed floating storage. And this is just a lot of that coming through. So we will start to see a bump. And not to say it's going to be huge, but it'll still move up, but still remain outside the normal cloud range. Then we look at imports. Imports dipped as we were expecting. Against kind of what we were expecting. We were expecting it to go up a little bit. Instead, we came down. It still made a higher low, and that's something that now as we go forward, we were expecting to go sideways up a little bit and then see that big step up. Instead, we came down. There were some movements in some of those delays. Now we're going to start to see that shift back up. Still well outside the 5-year average, but moving well within the kind of the bottom of that cloud. Then when we look at PADDIII, came back to the 5-year average, very close to seasonal norms. This is one that we expect to see that spike back up. And again, not to say that we're going to take out those highs, but we're just going to stay within the top of the cloud above that 5-year average. Then when we look at just general operational rate against the 29-year average, you can see that we're operating right along seasonal norms as we look over the last 2 decades. So there's not too much to say one way or the other. We're going to maintain a pretty steady pace. We don't see too much acceleration just because we're not seeing gasoline movements. There's a lot of product to work through, and that's where we're going to start to see some of these adjustments of oil coming in to backfill a bit. That'll slow down some of those draws. Try to adjust away from gasoline a bit, increase some distillate cut. Maybe pet coke has been doing very well. Not to say that they're going to focus on pet coke, but it's a nice thing to have. So those are some of those adjustments that we're going to start to see over the coming weeks. And then and this is just looking at over the next 4 to 6 weeks. And then as we get to the other side of July 4th, we'll have some good data points. And then we can kind of build out, what is the rest of summer going to look like from that point.